The credit process begins with the collection, analysis, and evaluation of information required to determine the creditworthiness of the borrower seeking credit from the bank. After the credit analysis is completed and borrower has been determined to be an acceptable risk, the credit officer proposes a loan structure for approval that preserves the strengths and protects against identified weaknesses of the borrower. The process ends with determination of a risk rating for the credit and loan approval or rejection. The bank's credit policy, lending standards, and procedures create the parameters for this process, thereby establishing the bank's appetite for risk, conservative or aggressive. The credit policy and standards should define acceptable loan purposes, types of loans and loan structures, and industries to which the bank is willing to lend, as well as the types of information the lender is required to obtain and analyze. The policy and standards help to create the framework, requirements, and tolerance limits for lending in which all bank credit personnel will engage. The lender must understand the bank's credit risk management system and his/her role in it, as the/she engages in lending activities, analysis, underwriting, and monitoring. The objective of the credit initiation and analysis process is to ensure that loans extended by the bank meet credit policy guidelines, and that credit standards and procedures established in the credit policy are observed in all geographic areas where the bank is active. The credit policy, updated periodically as necessary, should clarify what types of loans are acceptable to the bank, what loan purposes, tenor, collateral, structure, and guarantees the bank will accept in its lending activities. In other words, the credit policy establishes threshold requirements that any prospective borrower must meet. The credit initiation and analysis process should follow a typical diagnostic process flow, beginning with screening of potential customers and data collection, followed by identification, analysis, and measurement of risks, and then moving to a series of specific risk evaluation and risk mitigation actions in preparing for a credit decision. Credit underwriting is the process that banks undertake to structure a credit facility to minimize risks and generate the best return given the risks that the banks assume. The credit structure includes the term of the loan, collateral required, amortization requirement, timing of interest payments, and reporting requirements. Best underwriting practices include protections for the bank to mitigate the risks and increase the likelihood of loan repayment. Such protections include verification of cash flow to meet loan servicing requirements, proper loan covenants to preserve borrower strengths and limit weaknesses, and the requirement for sufficient, verified collateral and/or guarantees to provide a secondary or even tertiary repayment source. Underwriting also includes the reporting required of the borrower during the life of the loan. The higher the risk identified in the credit, the more information will be required and the greater the frequency of the information. This reporting forms the basis of post-disbursement loan monitoring. The structure of the loan is based on the analysis of the 4 credit foundations and should be approved in accordance with the credit authorities and approval procedures established in the credit policy.